when we look at the broad market valuations, in our view, they're just starting to get too high. The U.S. stock market at this point now is priced to perfection. So I see limited upside until earnings start to catch up with valuations, and that may take at least a couple of quarters before we see that starting to happen. The market is just pricing in, a lot of more, speculative aspects of the potential Trump administration. We're already pricing in the extension of the 2017 Tax Cut and Job Act. I think the market's also pricing in a much higher probability of additional tax cuts, both at the corporate level as well as personal tax level as well. And of course, just the anticipation of looser regulations, lower antitrust activity. I suspect we're going to see a pretty large pickup in mergers and acquisitions next year, especially in the tech space, because of course tech has been held down by a lot of the regulatory overhang in the M&A space. So look for a lot of more M&A to come next year.
What does the dollar's strength reflect to you at this point, given that it's at a one-year high? And, the underlying economic conditions are looking robust. The market is going well. It's just looking too good to be true.
Well, and that goes back to the earlier comment about everything in the U.S. really seems to be, priced for perfection, at this point in time. The U.S. market's trading at about a 6% premium to a composite of our fair values. Now, a lot of people may say, well, 6% doesn't sound like that much. But if you look at our price to fair value composite going all the way back to 2010, well less than 10% of the time has the market traded at that much of a premium or more. So while I'm still market weight in our asset allocation to U.S. equities, it's only really a matter because I think there's just enough tailwinds to overwhelm, the headwinds that we're seeing at this point in time. Our U.S. economics team is still looking for inflation to moderate, not only for this year, but going well into next year. They're looking for inflation to be below the Fed's 2% target. We did see a bump up in long-term rates, since the Fed started cutting and getting into that easy monetary policy. But, we're looking for long-term rates to come down next year. They're looking for an average of 3.6% on the 10-year, 3.2% on the 10-year in 2026. And of course, easing monetary policy. We're still looking for the Fed funds rate to get cut next year. They're looking for that to get all the way down to a 3 to 3.25% range. And as you guys were talking about earlier, we've also got now all the fiscal and monetary stimulus in China. So all of that, I think, is going to more than overwhelm the slowing rate of economic growth that we're forecasting in the U.S. for the next couple quarters.
Dave, I do want to get your perspective on how you're looking at the big tech names in the U.S., and especially in contrast to what the Russell 2000 did last week, and the expectation that these rate cuts will filter through to help CapEx for smaller firms, for smaller and mid-sized companies. And so where should the bias be?
Well, overall, when we look at positioning, we do see the best valuations today in not necessarily just the mid-cap, but also the small-cap space. So we think small-cap stocks overall should be an overweight, one of the few areas of the market that is trading at a pretty big discount, currently a 9% discount from fair value. But specifically looking at technology, that is a sector that we'd recommend to be underweight today. Overall, it trades at about 11% premium to fair value. Now, I think the interesting thing there, and showing my age here a little bit, when I'm looking at a lot of these artificial intelligence names, I wouldn't say we're not necessarily yet in a dot-com bubble, but I'm seeing a lot of these stocks, getting caught up in the AI boom that we don't think are going to necessarily benefit to the same degree that the stocks have moved up. So two names that we have sell recommendations on today are IBM and Oracle. IBM is a one-star rated stock, trades at a 50% premium to fair value. Oracle, also a one-star rated stock, trading at a 75% premium. So a name like IBM, we do agree it will get some benefit from AI. It'll get some increasing consulting business. But when we look at more of the legacy technology of their portfolio, we think that's still going to be something that's going to dwindle over time, and that will fall further and faster than they'll be able to make up for it with AI. And specifically looking at Oracle, I know our analyst there has a lot of concerns about their traditional database business, and that also being something that could get replaced over time by newer technologies. So at this point, really in the large cap growth technology space, IBM is pretty much one of the lone 4-star rated stocks trading at a 14% discount that we still see value in for investors today.